Good morning, folks, and welcome to your market report. Today is Friday, April 20th, 2018, and we're going to get right on with it right here by starting the charts right now. First thing we're going to look at is bonds and rates. And the reason why is U.S. 10-year now is on the move again. I've been watching it this morning and keeping a close eye on it. What I've been seeing is the U.S. 10-year is now up to 2.94%. It's getting up near its high it was before when it knocked the market down. Now, I told you in the danger zone, as soon as we crack 3% this time, this is the danger zone. Now, if we look here, we can see that it's just like I predicted. I said that this was going to happen the last few days. If you've been watching my show. This is exciting. This is exciting. There she goes. She's shooting up like a rocket. And the reason why is because the Fed was cheating on their diet. I call it a diet. This is what they were doing. If we take a look here on this lead up, this raise in bond yields, all the way up to this point right here at February 21st, they did something. I don't know what kind of cheating they did, but they brought those bond yields back down again. And the reason why they did it was this was exactly when the stock market was rolling over and falling. They panicked. They panicked. They did some sort of stimulus, backdoor stimulus. We didn't know what they were doing. We couldn't see what they were doing, but they drove these bond yields back down again to 2.73 or 2.72 or something like that, right? And it was temporary because they went back to what they're doing, and now look at the bond yields starting to rise again once they went back to what they were doing again. Now, this is very important because this is putting the pressure back on the market to fall again. Bond yields are back up to 2.942. The market, the stock market right now will be getting trembly. Let's take a look at the Dow Jones in relation. The Dow Jones is down 79 points today, but that's not a real fall. That is like just sitting there, not really reacting yet to the bond yields going up. Now, once these bond yields past 3%, that's only, what is it, 6 more basis points? Once they pass 3%, then the pressure's on the stock market where the stock market can fall. And quite seriously, folks, we could get the big one once it passes 3%. It doesn't have to get to 3.25 like I have predicted. It's going to get to 3.25 before it really reacts and we get the big one. It doesn't really have to. We could get the big one once it passes 3%. We're in the danger zone then. We've crossed the line once we're over 3%, in my opinion, and we're almost there. I mean, even now, you know. But I don't think right now. I don't think it's going to go this early. I really don't. I think it's going to take more pressure on it from the bond market before it rolls over, before it falls. But that pressure's coming because the Fed's back at it again. And they're not doing their stimulus anymore. They quit it. Let me go back here. I'll show you where they quit. They quit right here on the April 2nd, 2018. They stopped what they were doing. And you see the bond market turned again, changed direction back again. Nobody's buying these bonds anymore. From what I gather, last month, the Chinese did buy $10 billion worth of U.S. Treasuries, from what I gather, or close to $10 billion worth of U.S. Treasuries. So the Chinese are still buying, but the Chinese are very unconvinced. And will they buy again? I doubt it because of what the United States is doing with their trade tariffs. I really don't think the Chinese are going to buy in again. And where are they going to find buyers for this crap? I'm going to call it what it is, you know. They're going to have to buy them themselves. Otherwise, they're not going to have buyers, and these yields are going to shoot through the roof at that point. So now let's get on to silver. A lot of people are talking about silver, you know, and I'm going to tell you, honestly, a lot of people are talking about it, and they've been saying, okay, yesterday it's breakout, it's the breakout's here. I don't think the breakout's really quite here yet. I think we've found this new range in around 17, just over $17, lower than say 17.50, and higher than say 17.10 or 17. Say higher than 17, but lower than 17.50. And it's just found that new range. And look at it sliding along in that new range it's found. Once it got up to that, the blue line got up to that new range. And so the blue line was one day, it slid along one day, and this is the third day already. It slid along in this new range. It's just sliding along in that new range. It's kind of actually bottom bouncing right now in that new range. But it's staying there. It's holding. It's holding by the skin of its teeth, to tell you the truth, I think. Instead of this being some sort of a breakout, this is not what a breakout looks like in silver, by the way. A breakout in silver, by the way, would be even steeper than this blue line here where it went up. It would be going up like a spiking up, and it would continue to go up and up and up, right on off of the chart and up over top of where this chart is, and keep on going up and up and up, like $3 in one day. That is a breakout. And then $3 the next day. That's a breakout. This is like, what is it, 50 cents? This is like, I mean, I wouldn't call this a breakout. What the breakout that I'm looking for really is like $3 in a day. That's the breakout I'm looking for. And $3 the next day. And when we get that, well, maybe not quite that much, but I mean, if we get dollar days, we get a dollar day, and then we get another dollar day, then I'm going to say, hey, I think we got the breakout. When we get the second dollar day, I'm going to say, hey, I think we got the breakout then at that point, Because I'm going to tell you, silver can do what Litecoin and Bitcoin have done. Bitcoin and Litecoin have done that, and nobody pays any attention to them. They go up like that. Silver can do the same thing, and get ready. I mean, the breakout for that, I think, is coming. Not too far away either. This might have been a little tiny tremor of the breakout that's to come. What we just saw might be a little tiny taste, but just a little tiny taste, almost like when you got a wedding cake or something, and you're able to just take a little bit, just a little dip on the tip of your finger, to taste it, and that's all you get. You got to wait, This is what this is. This is a little tiny taste of what's to come, I think, maybe. Okay, so what we got here is, here's Bitcoin. Bitcoin, she's heading on up there, and nobody's talking about Bitcoin, but Bitcoin made bigger moves than silver. It was 82 yesterday or something down here, even 79 yesterday, and now it's 85.67. That's nice little move, in Bitcoin. And so, now let's take a look at oil and see what oil's doing. Oil's starting to taper down a little bit. It's down 43 cents on the day. But overall, I think oil's still on the upswing right now. I think it's gonna, when this number right here, 67.86 right now, when that number peaks 70, I think production's going to increase a little bit and help in the short term and help bring that maybe back down or level it back off, so it's not going to go too much above 70 in the short term. Long term, oil's going to go way up. It's just a no-brainer on that. In the long term, like in the next 2 years, oil's going to go way up because they're running through the cheap oil as fast as they can, and they're going to run out of the cheap oil, and the only oil that's going to be left is more expensive oil. Harder and more expensive to get it out of the ground. So the price is going to have to go up. Cryptocurrency market capitalizations. 374 billion. We're getting back up near 400 billion again, aren't we? And all the numbers are in the green again today. Oh, Bitcoin dominance, 38.6%. We see Bitcoin dominance falling off quite sharply, to tell you the truth. Now, I was predicting, I said Bitcoin dominance is going to drop. It was in the 40s, now it's in the 30s. I believe that it's going to drop down into the 20s or high 30s. It's going to continue to lose a bit of Bitcoin dominance. EOS is doing really good, solid, you know. Litecoin, 149 bucks. It's doing good, up 5%. Bitcoin Cash doing really great, up 14%. Ripple is really took off, but it's starting to fall off right now. Ethereum 587. Cardano 28 cents. IOTA $1.90. NEO $75. Now, for some reason, you know, I really like NEO and I really like Monero. Those are two coins I really like, NEO and Monero, and I like Dash. I like Dash too, 440 bucks. But I think one of my favorite coins of all is Litecoin. I really like Litecoin. And I got my eye on EOS right now, you know, and IOTA, those two. I really got my eye on those two. And that's what we got going with the cryptocurrencies right now. Now we're going to take a look. We took a look at the U.S. 10-year. We started with that, so we're going to end with the dollar. U.S. dollar index today. She's up 90.40. Now, I think this is more or less I think it's a temporary move yet. I don't think the dollar's ready to really move yet. This dollar, I'll tell you what I'm expecting, is when the market crashes, I'm expecting the dollar to go up, but not that much, not significantly. And when I mean the market crashes, not the initial crash. I consider the initial crash of the market when it rolls over from where it is now at 24. What is the market at right now, right this second? 24,538. I expect that when the market rolls over from 24,538, when it hits 20,000, that's the first stage of the crash. And we're in that first stage already. We've already entered into the first stage of the market rolling over. Now, look, the market's starting to respond to the bond price, the bond yields right now. It's already starting to respond. It's fell from 70 points to 126 down today. We could end today down around 350 or even 400 points down. That wouldn't be impossible for the bond yields today to react to the bond market today because the bonds are getting up quite high. That might take a little bit of steam off of the U.S. 10-year, the bonds, because what these guys are doing right now is they're rolling over on bonds and they're heading into U.S. 10-year because the yields look good today. And they're buying a little bit, and they're coming out of one, coming out of one market and going into the other. But I'm going to tell you what, the difference is too great. If a lot of them come out of the stock market, okay, and they go into the bond market, that'll temporarily give the bond market some relief. But I say temporarily because overall the bond market's much bigger than the stock market, and so as they come out, after a while, the bond market's going to saturate who comes out of the stock market, and in the end, there'll be no place to go. And so this is a temporary effect at best. So we got them coming out of the bond market and the stock market and going into bonds. That'll take a little bit of pressure off the bond market, but not all, because the stock market's not big enough. The bond market's way bigger, and so that they can come out like they're doing and go into bonds, and it'll take a little bit of pressure off the bonds. What is it, 10 times bigger, something like that? Seriously, and an awful lot of people don't know that. They don't know that the bond market's that big. It's so big that the stock market is like would be like a dog jumping on top of a great big guy, you know, and when he comes and he flies into the guy, he's gonna hit the guy, but he's not as heavy. Like, say the guy weighs 250 pounds and the dog weighs 30 pounds. The dog can fly into the guy. He's going to push the guy a little bit, but he's not going to knock the guy over completely, or maybe he could, but there's a weight differential there, and that's the weight differential between the bond market and the stock market. The stock market's like the 30-pound dog, and the bond market is like the 250-pound guy. You know what I mean? It's that much big. It's such a big market. The bond market's absolutely huge, and so the amount of money that comes out of the stock market in a stock market crash Can have an effect on bonds if they run into bonds, you know, but it's not going, and it can have effect on the dollar too, but it's not going to have as big an effect on the bond market as you would think, really. The bond market can kill it. In other words, the bond market, if the bond market really wants to roll over and there's really no buyers for the treasuries and they're really pumping way too many treasuries out there, the stock market's not going to be, in the end, not going to be able to stop it from rolling over and the bond yields going way up. It just ain't going to happen, and they'll continue to go up, the bond yields. But it can have a temporarily of a little bit of an effect. Anyway, that's what I was trying to explain. That's what I think we're actually seeing here. With the Dow Jones falling today, an awful lot of that money might be running into bonds today because, okay, but the bond yield is still going up. Let's see here. There's it going up, the bond yield, 2.942. We could see that slow that down a little bit. It's been going up at this angle. It might slow it down so it's not going up at quite such a steep angle later today. Okay, we might see this angle taper off later today, and not go up quite as because of what's coming out of the stock market. And we might be seeing a few buyers into the bonds because these yields are very attractive. Everybody looks for yield. And I think that the yield they're making on the stocks right now are around 2.2%. And right now the bonds are somewhat 2.94. So there's a little bit of a spread there between yields, you know, and that's attractive, that spread, you know. Now, when the bond yields taper back, the spread's not so attractive. But as it goes over 3%, it's even going to be more attractive. And that's why I'm saying that the stocks could roll over. Anyway, okay, listen, I've been jabbering on a little bit. Thank you guys for listening. Like and subscribe, and we'll catch you in the next market report. Bye.